Why do alternative assets matter? Well, first you need to understand what they are. For example, investing in alternatives means investing in infrastructure like water pipelines, toll roads, ports and airports. Growing businesses through private equity. The intelligence of a hedge fund manager who trades globally in currencies, equities, commodities and bonds. Venture capital, where investment turns ideas into the businesses of the future. Water rights, agriculture and timber production, and unlisted property like residential developments, office towers and industrial estates. Internationally, these are all mainstream investments, but here in Australia, they are seen by some as niche. For some reason, Australians also own a lot of shares. However, the global financial crisis demonstrated how an overexposure to equities can leave investors with big losses. So how are the big guys doing this in the US? Unlike the average Australian investor, the Harvard Endowment Fund allocates 58% of their portfolio to alternative asset classes. They also have a track record of incredible returns. Over the last 20 years, the Harvard Endowment Fund have achieved an average annual return of 12% per annum, compared to the benchmark market return of 9.1% per annum. That might not sound like much, but over 20 years, an investor with the endowment fund would have made nearly twice the capital gain of an investor who simply achieved the benchmark return. This means that investing in alternatives has a proven record of consistently high returns in the US, and a healthy allocation to alternatives and consistent outperformance are closely linked. The good news is that Australians are starting to catch on. The Australian Future Fund has nearly $100 billion in assets under management and is ahead of the curve with a 35% allocation to alternative investments. This allocation to alternatives helped the fund outperform its target. So if your portfolio hasn't held up quite so well lately, maybe it's missing something. Investing in alternatives clearly offers rewards, but it can also be challenging. Alternatives are active, not passive investments, and managing the trade-off between risk and reward is much harder than in other asset classes. Not all alternatives managers are created equal, and finding the right manager really matters. While other fund managers get rewarded for beating benchmarks, alternative asset managers only get rewarded if they are profitable. This means that the investment manager's interests are aligned with yours. They will only make money when you do. But Australians don't invest much in alternatives at the moment, so there aren't many managers out there who you can rely on to outperform. At times it may seem too hard, however picking the right manager will have a greater impact. The reality is that alternatives are an essential part of any well-balanced portfolio. When you're investing in alternatives, you're getting access to market ideas and asset classes that will have a positive impact over the long term, not assets whose values rise and fall based on an often volatile stock market. We want to help you increase your allocation to alternative assets. Let us help make a difference to your financial future through the power of alternative thinking.